Hello everybody, it's a busy week I'm sure for everybody, keeping track with the earning releases. This is a request from a viewer who wanted to know about the FCT's first half 23 numbers. So in conclusion, I thought the numbers were actually a slight beat. I thought the numbers are better than what I expected, but of course it depends on your perception. But I think the share price is also not cheaper. In fact, I talked about it in a previous video. I sold my FCT stake and I rotated into Singtel. So if you're interested, you can find out why I did it in the video previously. So this is the share price performance for FCT for the past 1 year. I thought in general the share price has been range bound between 2.3 and 2.1, which is what you expect, right? This is a very well run REIT, very good management, very good assets located besides the MRT stations. So this is solid solid REIT that I'm happy to hold for a very long time. This was the sell off in late 22. Unfortunately, I didn't buy anything during this sell-off though, because I was busy buying everything else. I was buying AIMS, Star Hill, Capital REIT, A REIT, MLT, MIT, you name it. The irony is that because this REIT is quite solid, therefore I think it didn't really fall enough for me to buy it. I was busy allocating my capital to other really sold off REITs. I talked about it previously. I mentioned many times already. So if you're interested, you can go visit what did in late last year, from September to November periods, on what I did and subsequently. And this is of course the recovery. I sold everything at around 2.2, I think. Subsequently, share price went to 2.3. So of course, that was a bad timing on my part. And post earnings releases, the share price actually corrected. I'm not sure why, but maybe because people were looking at the FOMC next week and thinking that they will just take profits. Maybe people were disappointed with the results. But to me, actually, the numbers were a beat. This is the DPU, and it's flat. Actually, I was expecting the numbers to come down more significantly, maybe to like a 6 cents level, because I was thinking the interest rates will have a bigger impact. But the DPU was actually flat. So to me, the numbers were beat. If you look at the timeline for acquisitions, they bought Next and completed in 6 February, and Waterway Point in 8 February. So this stuff will contribute around 2 months of impact, which is quite marginal. So actually the top line growth was mostly due to organic growth. So higher revenue, higher MPI, higher reversions, higher occupancies, good retail sales. If you look at the impact Vivo City numbers, actually the sales were also very robust. So I think the Singapore shoppers are back in full force shopping in complete heaven. So NAV was also flat. So I think this is the metrics for the REIT. I thought it was very healthy, very strong. But nonetheless, I thought the share price was expensive. So let me talk about why. So why did I sell the REIT earlier? Because the gearing went up to 40%. Simple as that. If the REIT had stayed at 34%, I would have stayed with the REIT and collected dividends. But I'm not comfortable in this rising rate environment to stay with REITs with a 40% gearing. If you look at the cost of debt, I'm surprised that the cost of debt hasn't risen a lot more. So it's just a 10 basis points rise. I was expecting a higher rise actually. So that was quite surprising to me. I need to say though that I hold a very different point of view on interest rate movements and the Fed actions coming in the next few months. I think if you look at what's happening, the market is saying that Fed will cut rates and so on and so forth. I don't think so. I think Fed will stay higher for longer. So I'll talk about it later. This is also another concern for me, which is the debt maturity profile for the REIT upcoming. So quite a high substantial amount will be expiring in the next 3 years. 18%, 17.5, 23% over the next 3 years. And because I think that rates will stay higher for longer, this is going to be problematic in my view. But if you think that the market is right and the Fed will cut rates, then you don't have to worry about it. But to me, I hold a different view, therefore I'm concerned. There's also a decent chunk of this stuff over here, 200 million, which is MTN. So it remains to be seen where they can refi all this MTN and the bank borrowings and the effect of rising rates. So this is the market view of the Fed funds rate currently. I think for REITs nowadays, and pretty much all the time, you need to have a view on interest rates. If not, please don't touch REITs. This is the CME Fed Watch tool, and market is saying right now that by end of 23, median rate will be at 4.5 to 4.75. So given that rate is probably going to go to 5%, 5.1% in May, people are saying that you're going to have 75 basis points or 3 cuts by end of this year. I don't think this is realistic at all. I think the Fed will stay 5% and they'll hold it for the end of the year. I think they'll hold it for maybe 6 months to 9 months before deciding whether or not to cut it. So why do I think so? Well, I think end of the day, the Fed officials are all civil servants, right? So with a rising interest rate, with a rising inflation, and they hike rates so fast, if they cut rates at the first sign of inflation easing, and then subsequently inflation picks up, then they'll look like morons, right? So to me, if you're a civil servant doing your job and don't want to look at a cloud, if you raise rates and then inflation goes down, you keep rates high to make sure inflation stays down for maybe 6 months, and then after that you can think about cutting, right? So I think the market is completely wrong in expecting cuts so soon, so fast. In fact, if you look at the expectations by end of next year, so end of 24, people are saying that the central rates will be at 3%. So another 1.5% cut by then, by another 1 year. I don't think this is realistic at all. Of course, it can happen, especially if the US falls into big recession. Then the Fed will cut rates really aggressively. I don't really think this is gonna happen. But of course, it depends on you. If you think the Fed is gonna cut, and if you think that the US is gonna go into a big recession, then maybe it's right. But look at the earnings from Amazon, Microsoft, Apple, Facebook. Well, things are slowing, but not collapsing. So to me, the market is wrong. I think the rates will stay higher for longer, and therefore I sell everything which is too expensive. So if you look at the valuation of the REITs nowadays, basically for FCT, it's a very good REIT. Therefore, it trades at as a bond proxy. So in general, it trades as a function of the 10-year Singapore government bonds. So right now with 10-year bonds at 285, I think you expect a 3% pickup, and therefore 585 is the expected yield for FCT, which is pretty much where it is, right? If you look at the DP of around 12 plus cents and 2.2, that's around 5.7, 5.6. So roughly there. And because I think that the bond yields are too low, therefore I think this is too low, and therefore I sold everything for FCT. What do I expect to be fair compensation? I think something like 6.5% for the top tier REITs would be ideal. Which is why if you look at what I did for past 1 month, I've been selling the top tier REITs, which is yielding less than 6%. So a lot of them are out actually. In fact, I sold more than 60% of my REITs portfolio. I talked about it previously actually. I think the last video. Also, subsequently, I think there's a lot of potential acquisitions coming in Next, Waterway Point, North Point City, South Wing. So these are 3 huge assets, right? I think the assets are good quality though, and they're gonna be accretive. I think, if you manage to get a good funding mix. But nonetheless, there are still a lot of assets coming. Therefore, there'll be plenty of equity raising opportunities, and therefore, I think I'm in no hurry to buy in the open market this REIT when the yield is not that attractive to me. I prefer to take my time, wait for equity raising, share price to be determined, and then decide whether or not I want to subscribe to the rights and to buy subsequently. So to me, while the units are not cheap, therefore I'll wait. For investors who are interested in exposure into retail assets, I actually find Star Hill Global to be a much better proposition. It's of course a much smaller REIT, much less covered by analysts, but it's pretty well run. But of course, it comes with its risk as well, because this stuff has assets in Australia, Malaysia, Japan. So if you're not comfortable with assets overseas, then well, you can stay with FCT because everything over here is in Singapore, right? So there are arguably a higher risk for this fella, but I think it also comes with higher rewards. At current levels, this yields more than 6.5, almost 7% for this stuff. And look at the share price performance for Star Hill versus FCT on a 5-year perspective. Star Hill has really underperformed, which I think is not very deserved. In fact, compared to 5 years ago, it's now 24%. whereas FCT have stayed very stable through the years, even during COVID. But I think this stuff is actually a much better value for money, especially with the impending recovery in tourist spending in the Orchard Road belt area. So for me, I bought a lot more Star Hill Global this year on top of buying what I did last year, and I think this is a better proposition. But of course, the choice is up to you, the investor, to decide what risk reward you want, what is cheap, what is expensive.